Oil prices rebound as OPEC Plus output hike underwhelms, but global tensions simmer. Oil prices unexpectedly bounced back on Monday, rising more than $1 per barrel and erasing a chunk of last week's losses. Why the sudden recovery? It all comes down to OPEC Plus and some moves that caught the markets off guard. But here's where it gets controversial. Many people assumed the oil cartel would flood the market with supply, but the real story is far more nuanced and tied to escalating global tensions. Let's break down the facts. On Sunday, OPEC Plus, which includes not just the usual oil giants but also Russia and several allies, agreed to a modest production boost. Specifically, 8 members will increase their collective output by only 137,000 barrels per day, starting in October. To put this in perspective, that's a far cry from prior months, when output rose by more than 500,000 barrels per day in both August and September. Many analysts had anticipated a much higher figure, so the smaller hike caught traders off guard, leading to what's famously called a sell the rumor, buy the fact reaction in financial circles. By 10:31 a.m. GMT, Brent crude had jumped $1.28 to $66.78 a barrel, while U.S. West Texas Intermediate futures gained $1.20 to reach 63.07 cents. This recovery follows a brutal end to the previous week when weak U.S. employment data triggered fears of reduced energy demand, sending both benchmarks spiraling by more than 3%. But don't miss the bigger picture. OPEC Plus has been increasing output since April, after years of keeping a tight lid on supply to support prices. However, with the Northern Hemisphere heading into the slower-consuming winter months, some experts worry about a potential oversupply, even with this limited October increase. And here's the part most people miss. The nominal increase might look modest, but in reality, several OPEC Plus members have been producing above their agreed quotas for some time. That means the extra barrels promised are likely already entering global markets anyway, so the real impact on supply is much smaller than the headline number suggests. Meanwhile, simmering geopolitical issues are adding to the uncertainty. Rumors of renewed USSS sanctions against Russia are swirling, especially after President Donald Trump hinted at a potential Phase 2 of restrictions in response to the war in Ukraine. New sanctions could disrupt the flow of Russian crude, tightening supply overall and keeping prices volatile. And just this weekend, Russia escalated matters with its largest air attack on Ukraine since the war began, igniting key government infrastructure in Kyiv and tragically claiming multiple lives. Adding more intrigue, Trump also announced visits from European leaders this week to Washington, where the future of the Russia-Ukraine conflict, and by extension, global energy security, is up for debate. And here's a potential debate starter. Some Wall Street heavyweights, including Goldman Sachs, are forecasting that increased supplies from other regions, especially across the Americas, could create a slight oversupply by 2026, despite Russia's output being revised downward. Still, Goldman stuck with its price forecast for next year, predicting Brent will average $56 and WTI $52 a barrel in 2026. So where do you stand? Do you think OPEC Plus is playing it smart by keeping the output hike modest in these uncertain times? Or are they risking an oversupply that could destabilize prices? And will tougher sanctions on Russian oil help bring stability, or only create more volatility for producers and consumers alike? Jump into the comments and share your take. This is one of those oil market moments where everyone seems to have an opinion, and the debate is heating up.